Hey everyone, and welcome back to the channel. If we have not met yet, my name is Mark Rusin. The roller coaster of a year continues in the stock market, and peer technology growth investors have taken it on the chin with the NASDAQ composite trading in and out of bear market territory. For those of you unaware of the term, a bear market is any time a stock or ETF or index is trading 20% below its recent highs, which is exactly where the NASDAQ trades as of this recording. And although I believe in high quality technology companies for the long run, right now investors are taking in a lot of information. And one of those being rising interest rates and how those impact companies that are high growth companies, how those impact their valuations, how those impact their future growth potential. The Fed is expected to increase interest rates this week. In fact, they may have already done so by the time you are watching this video. And this impacts high growth stocks in a big way because many of these companies rely on debt to grow their earnings. And that debt is about to get a little more expensive throughout the remainder of the year. All this goes to show you is the importance of a high quality diversified portfolio, which I hope is what you see when you take a look at my portfolio today, my dividend portfolio. Whether the stock market is up, whether the stock market is down, whether interest rates are rising, whether interest rates are decreasing, whether the economy is roaring or it is sitting stagnant, I can rely on these high quality dividend stocks to provide me with passive income. Dividends are one of the best forms of passive income. It's essentially earning money while you sleep. But there are a lot of dividend haters out there that you will see on social media. I'll get comments on a weekly basis of, I would rather my company that I invest in reinvest those earnings back in so they can continue to grow. Well, that's all great, but how's that doing for you right now? How's the likes of a Roku or a Zoom? Just to name a few stocks, they're reinvesting and growing earnings, but their stock's down 30, 40, 50+% right now. It is all about balance. I want to ask a huge favor from you. As I put these videos out for free and I try to be as transparent as I can with you, just do me a huge favor as it helps the growth of this channel moving forward, and just click that like button down below. And as a disclaimer, I am a CPA and not a financial advisor, as this video is for informational and educational purposes only. Do not take this as financial advice. Also, if you are looking for a new investing platform that is just downright awesome, check out M1 Finance, and they are giving away $50 free for every new account that is opened right now and funded within 2 weeks of opening. All right, with that being said, let's get started. Okay, so here's a look at my dashboard, and many of you have reached out about grabbing a copy. So if you haven't yet signed up for my Dividend Investors Edge, make sure you do that in the link down below, as I will be sending out a link to this very own dividend portfolio tracker for your enjoyment in the near future. Now, looking back at the tracker here, the S&P 500 on the year is down 13% as of this recording. So our dividend portfolio right now is actually outperforming the S&P 500 or the broader market. Although the only issue is we're still in the red. But at the same time, this stagnant period that we're going through where we're seeing short-term pressures is allowing us to add to positions that we believe in the long term. So do not fret over these short-term pressures. Short-term pain brings long-term gains. So right now, looking at the portfolio as a whole, we are down 3.2% on the year, or roughly $6,400, which it was actually a lot more. It was well over $10,000 a few weeks back. So we have clawed back a lot of those losses so far. And we are inching closer and closer to turning green on the year. The reason I'm not too concerned with where we're at with the portfolio right now is due to the fact that I invest in high quality positions. I have a strong foundation with the S&P 500, and then I have sprinkled in individual high quality dividend paying companies. If you look at it, or really think about it, the S&P 500 over a 20-year span has never, ever had a negative performance. Plus, the likes of Johnson & Johnson aren't going bankrupt anytime soon. An Apple isn't going bankrupt anytime soon. a Microsoft, Realty Income, and the list goes on. So definitely take advantage where you see opportunities during this time. So in terms of annual dividend income, looking at the portfolio tracker here, you can see that our projected dividend income for the next 12 months is a little bit over $5,000, and that equates to a dividend yield of roughly 2.59%. The projected dividend income for the next 12 months actually increased 3.2% over the past update that I gave you roughly 30 days ago. And since that update, the dividend income has increased $157 just in the last 30 days. And as I just mentioned, the dividend yield is 2.6% for the overall portfolio right now, which is actually pretty solid given the fact that I invest primarily in dividend growth stocks, which tend to come with lower yields, but they're growing their dividend at a strong clip each and every year. So with that 2.6%, I'm pretty happy. Now let's run through the positions quickly and see how they rank within the portfolio. As I mentioned, I have a strong foundation of S&P 500 there at the top. So you're always going to see that Vanguard S&P 500 index fund at the top, as it has a 10% weighting, over a 10% weighting right now. Followed by the Dividend Appreciation Index Fund. And then we have my top individual dividend paying stock, which is AbbVie. It has been AbbVie for years now, and the company has just been on a run. And followed by Bristol Myers Squibb, Johnson & Johnson, Lockheed Martin, the Schwab Dividend ETF, another S&P 500 index fund, VC Properties, Apple, the Vanguard High Yield ETF. There's my cash position, which was in the top 10 as of the February portfolio update. But as I'll show you here in a few moments, I did make some buys, so that cash position has fallen a little bit there. Next, we have Deere Company, Visa, Altria Group, Microsoft, the iShares Dividend Growth ETF, the Consumer Discretionary ETF, Realty Income, WP Carey, Starbucks, National Retail Properties, the Vanguard Tech ETF, Bank of America, Iron Mountain, Verizon Wireless, Broadcom, Public Storage, Raytheon, Simon Property Group, Store Capital, and 3M. So my goal is to really have roughly around 30 positions in my portfolio. Now this is really up to you, how much you want to keep up, especially when you have individual stocks. How much do you want to keep up with the day-to-day and the quarterly reports? But for me, I'm invested in this stuff all the time. I'm looking at my portfolio a lot, so I am following each and every quarterly report. So maybe your portfolio can have 5 positions or 10 positions, or maybe you're someone that's gonna, be in there every single day and really study these companies and have, say, 40 positions. So it's really up to you and the time you want to spend on your portfolio. Okay, now that you've had a chance to see my latest holdings as of this update, let's now take a look at some of the moves I have made since our last portfolio update, many of which were just made in the past week or so. So in terms of buys, I bought roughly 12 more shares of Microsoft, or roughly $2,500 of Microsoft shares. I also bought 50 shares of Bank of America, which equated to a little over $2,000. I added another 15 shares of the monthly dividend paying company Realty Income, stock ticker O, which was slightly under $1,000 invested. And then I continued to nibble at that Starbucks position, considering how much they have fallen here in recent weeks. And this downward pressure is just giving me an opportunity to continue to add more to that position in the long run. Now, in terms of positions I have sold. Now, some of these may be a surprise, and I do not sell positions very often. I'm a long-term investor. I'm in it for the long term. Unless something drastically changes is the only time I'm really going to sell. But another reason that I sell is just due to weighting. If a individual position outgrows the position I'm comfortable with, or the weighting I'm comfortable with that company holding in my portfolio, then I will trim a little bit. This doesn't mean that I dislike the company. It just means that it is outgrowing its position in the portfolio. So one of those positions I sold out of was an S&P 500 ETF, and its stock ticker was IVV. Now, when you're looking at my portfolio, you'll see that I have a lot of S&P 500 exposure. And this is due to the fact that I have accounts at M1 Finance, Fidelity, and Vanguard, which is why I make this dividend portfolio tracker, so I can bring everything together in one spot and I can really just look at this on a day-to-day basis. Now with IVV, I was just having too much overlap. So it's not that I dislike the S&P 500. As you know, I love the S&P 500, but this was the smallest position in an overlapped area. So I decided to nix that one. The other one may come as a big surprise to you, considering if you have followed me on social media, you know that I love AbbVie, stock ticker ABBV. Now this company has been on a tear the past 6 months and this year per se. Again, remember I just mentioned how much the S&P 500 was down on the year alone. Well, when you look at AbbVie, this company is up 15% on the year. And over the past 6 months, the company is up a staggering 45%. And the weighting just grew way too much. I never want to have an individual stock have a double-digit weighting in my portfolio. So what I did here was I sold roughly 29 shares or $4,200 close of shares of AbbVie just due to this outsized position. So that's really the portfolio in a nutshell here for the month of March. Now, if we move over to the next tab, you will see that we have our dividend calendar. Now I update this every time I get a new dividend paid. So you can see over the first 2 months, we had roughly $200 in dividends paid in January and $340 paid in February. Now March, we're expected to receive a little over $600, which will be a new all-time monthly record for this portfolio. You can see the yellow ones are ones that haven't been paid out. So March is, again, still a big month, and we're expected to receive a lot more dividends. So continue rolling in here as we close out the remainder of the month. The final tab in this portfolio is really just tracking performance. And just recently, we just ticked into the green for the month of March, which is awesome. February closed out a little rough there, but we have bounced back and we have gains of 2,500 so far here in the month of March, with the portfolio up 1.3% in this month so far. So that's the portfolio update for March. I hope you enjoyed the video, and if you haven't done so yet, hit that like button down below, as that is huge for the growth of this channel. And also in the comments section down below, let me know some of the top dividend stocks that are on your watch list right now to buy. Also in the comments down below, let me know if there's other types of videos you want me to start rolling out. Here in the near future, I'm going to begin doing some more focused dividend videos, such as dividend stock analysis. So I'll be rolling out a video here in the near future on Realty Income that's just really going to focus on that one company and just going through an overview and looking at different valuations, whether I believe, in my opinion, the stock is a buy, a hold, or a sell. Again, I hope you enjoyed the video, and we will see you next time. Take care.